Imagine financial charts not just as lines and bars, but as a kind of secret language, a visual code telling us who's winning the battle between buyers and sellers. What if I told you that by learning this language, you could actually spot future market turns before they even happen? Today, we're unlocking that ancient yet incredibly powerful language of the markets. Okay, let's unpack this a bit. Today, we're taking a deep dive into Japanese candlesticks, really a cornerstone of technical analysis. You've sent us a stack of insightful sources, and our mission really is to pull out the core insights. We want to help you understand how these, well, seemingly simple visual cues can be a powerful shortcut to making more informed trading and investment decisions.
Exactly. And we're going beyond just basic definitions here. We'll explore not just what these candlesticks are, but crucially, why they've become such an indispensable tool for traders everywhere. They provide a depth of information that, frankly, other chart types just don't. And yes, we'll definitely unravel some of the most significant patterns, single, dual, and triple candlestick patterns that signal those crucial shifts in market direction.
Right. Have you ever just stared at a stock chart, maybe all those colorful bars just look like a blur, and wished you knew their hidden meaning? Did you know a single hammer pattern can signal a market rebound, or that three black crows might predict an incoming storm? And what about a shooting star? Is it as nice as it sounds, or is it actually a warning sign?
Well, these aren't just pretty shapes, are they? They're like the battle scars of market psychology, etched into every single movement. We'll be asking things like, how can a pattern called the hanging man predict a pretty dramatic fall? Why does a doji candle, which has literally no body, why does that speak volumes about profound market indecision? And maybe most importantly, how can understanding these visual clues give you a real edge in highly volatile markets like Forex, stocks, or even commodities?
Okay, so let's lay the foundation first. What exactly are Japanese candlesticks? At their core, they're a highly visual way to see price movement on a chart. Think of them like a trader's magnifying glass, really, allowing you to read price action and apply strategies with much greater precision. That's especially valuable in really dynamic markets like currency trading.
Yeah, and while they absolutely shine in Forex, it's really vital to grasp that this rich, potent charting style is applicable everywhere. It's incredibly useful across all financial markets. We're talking stocks, commodities, precious metals, even oil, sort of a universal language for price action.
And their biggest advantage, I'd say it's the visualization. They offer a superior picture of price movement and patterns compared to older types like line or bar charts. This translates directly into helping you spot trends, pinpoint those crucial entry and exit points, and know when it might be time to lock in profits.
Precisely. That's why you always hear that every serious trader absolutely must have a good handle on what these candlestick meanings and patterns are saying. When you're fluent in this visual language, you're just much better equipped to identify significant price changes and, maybe most importantly, find those high probability trading opportunities.
So what information is actually packed into one single candle? Well, each candlestick is basically a summary of a specific time frame. It has an open price, where its solid body starts, and a close price, where that body ends. Then the high price is the very top point of its thin shadow or wick, and the low price is down at the bottom of the wick. The body itself, the solid part, shows the difference between the open and close. And those shadows or wicks, they show the absolute highest and lowest prices reached during that specific time period.
And the color coding is pretty intuitive usually. Green or maybe blue typically signals an upward or bullish move. That means the close price was higher than the open. Conversely, a red candle usually means a downward or bearish move where the close was lower than the open. And time frames are absolutely fundamental here. If your chart's set to daily, each candle captures 24 hours of price action, showing the open, high, low, and close for that day. But this applies to any time frame, minutes, hours, weeks, whatever you choose.
It's amazing, isn't it, how much data one small visual can pack in just at a glance.
Exactly. And this rich data set, open, close, high, low, all in one place, makes spotting price patterns much easier. It allows for, well, superior analysis. That's a clear advantage over other chart types.
Right, and the chart itself is the canvas for all this market storytelling, isn't it? It's just that graphical representation of price movement over different time frames for whatever asset you're looking at. Currency pair, stock, commodity, you've always got time along the bottom, the horizontal axis, and price running up the side, the vertical axis.
Yeah, and its importance in technical analysis, well, it's paramount. Charts let traders meticulously look back at historical price movements. That's really the foundation for trying to predict future ones, right? They allow for real-time monitoring of price patterns, especially those candlestick patterns we're talking about. And they make it easy to directly apply various technical indicators. These are basically mathematical calculations based on price, volume, sometimes open interest, designed to help traders make more informed decisions. We're talking tools like the RSI, the Relative Strength Index, which helps you gauge if something is maybe overbought or oversold, or momentum indicators that show the speed of price changes. Charts even support things like expert advisors, EAs, automated trading strategies on some platforms.
And when it comes to the main chart types you see, you've got the basic line chart, the slightly more detailed bar chart, and then, of course, the overwhelmingly popular Japanese candlestick chart we're focusing on.
Right. And while bar charts do show the open, close, high, and low, they lack that really distinct solid body that makes candlesticks so visually informative. That body just makes it immediately understandable, turning raw data into a much clearer narrative.
And to make these charts even more powerful, we often layer on technical indicators. Some, like Bollinger Bands or moving averages, are called overlays. They appear right on the price chart itself. Others, like that RSI we mentioned, are oscillators. They usually sit in a separate window below the main chart.
Now, when it comes to the software that actually brings these charts to life, there are definitely some clear market leaders out there. MetaTrader 4 and 5 are probably the most popular trading platforms. They offer really robust charting, tons of built-in indicators, and you can even add external ones. MT5, for instance, offers more time frames than MT4, which is handy. Then there's Netdania. That provides live prices and charts for an even broader range of markets, commodities, currencies, indices, oil, you name it. It even supports Arabic, offers even more time frames than MetaTrader, and various chart types beyond just candlesticks like line and dot charts too.
And here's a huge plus. Both MetaTrader and Netdania have smartphone apps, right? For iPhone and Android. This means you can access these pretty sophisticated charts directly from your phone anytime, anywhere, which is amazing for staying on top of things. So as you can probably tell, understanding these charts is absolutely crucial for any serious trader. But navigating the financial world also means picking the right tools. Look, because there are sadly so many scam trading platforms out there these days, ones that aren't really about genuine trading or investing at all, we've looked around, we found a safe global platform that we think is, well, maybe the best investment platform available right now. Through it, you can trade stocks, gold, currency pairs, Forex, and loads of other markets too. It's also super fast for withdrawals and deposits, which is important, right? And you'll get a 50% bonus on your first deposit. You'll find the link for that down below in the video description. Okay, so now that we understand the building blocks, those individual candle parts, let's dive into some of the most powerful single candle patterns. These patterns, just by themselves, are like powerful words in the market's language. They can shout a pretty clear message all on their own.
Right, first up, let's talk about the shooting star pattern. Picture it like a rocket that shot way up, but then immediately lost power and fell back down, leaving this really long tail above it. It's a single candle pattern, and it appears distinctively at the top of an uptrend. And its message, a potent bearish reversal is likely coming.
Okay, so structurally, it has a tiny body, almost pinned right at the bottom, and that really defining long upper shadow, usually at least twice the size of the body. That shadow represents a huge rejection of higher prices. It often has a very short lower shadow, or maybe none at all. It can be green or red, but honestly, the shape and where it appears, the context, that's what really matters.
Exactly. Its meaning is pretty profound. It shows the market tried to push higher at the peak of an uptrend, it failed completely, and then it closed right back near the opening price. This struggle clearly signals that the previous buying pressure has just run out of steam. Sellers are now aggressively taking control, and that often points to a price decline.
Now, here's a really critical point. A shooting star should not be traded in isolation. You need confirmation. Look for it alongside other technical indicators. Maybe an RSI showing overbought conditions. Or, importantly, a clear failure to break through a significant resistance level. That price point where selling interest is strong enough to act like an invisible ceiling, stopping prices from going higher.
Okay, moving on to its more optimistic sibling, the hammer pattern. This is another powerful single candle reversal pattern. But this one appears distinctly at the bottom of a downtrend, and it signals a potentially robust bullish reversal. It's like the market smacked into a concrete floor and just bounced right back up with force.
Right. The hammer usually has a relatively small body, a very long lower wick, often twice the body size or even more, and usually no upper wick or a very small one. This shape visually represents the price being pushed down hard by sellers, only for buyers to step in just as aggressively. They reject those lower prices and push the close back up, near the open, or sometimes even higher. It's a real fight back.
And there's also an inverted hammer variation. It looks like a regular hammer, but flipped upside down. It appears at the bottom of a downtrend, too, usually a green bullish candle with a long upper wick and very little lower wick. Both signal a potential turnaround is coming.
So how do you actually use it in trading? Well, it acts as a pretty powerful buy signal after a downtrend. It suggests sellers are losing their grip and buyers are stepping in. Now, if you were already in a short position, seeing a hammer is a clear sign to maybe think about exiting and taking your profits.
Yeah, but for confirmation, you really want to see increased buying momentum coming in right after it forms. Maybe check a volume indicator for a surge in buying activity. That helps validate the entry signal. The more signals aligning, the stronger the conviction for a potential sustained upward move.
Okay, next up we have the spinning top pattern. This one's characterized by a pretty short body and long shadows, roughly equal in size, both above and below. It can be green or red, bullish or bearish. The color isn't the main point here.
What's really fascinating about the spinning top is what it represents. Profound indecision in the market, a perfect stalemate between the buyers and the sellers. It's like a moment of pause, a clear sign that neither side really has control. Now, it could lead to a price reversal, but only if it's strongly confirmed by other factors. Things like hitting a crucial support level that's like an invisible floor, where buying interest tends to stop prices falling, or maybe seeing something on the RSI. It's quite versatile. You can see it uptrend peaks, downtrend bottoms, or even just moving sideways.
And perhaps the most visually striking candle, the one that just screams indecision, is the doji candlestick pattern. The doji looks like a cross, right? It's notable because it has no real body, meaning the open price is identical or very nearly identical to the close price. It's like a perfect flat line in terms of net movement for that whole period.
Yeah, that distinctive shape just screams market hesitation. It signals a clear lack of strong price movement in either direction. And crucially, it often indicates decreasing momentum in whatever the current trend was.
Yeah.
It's like the market is holding its breath saying, look, I am completely unsure which way to go next.
Now, what's really vital to understand about the doji is that it does not give you a direct entry signal. You don't just buy or sell because you see a doji. Instead, think of it as additional information. It tells traders, hey, maybe pause, reassess the situation, or perhaps consider closing out open positions if you were riding the previous trend. It's a strong signal for caution, not necessarily immediate action.
Exactly. And while there are several types of doji, maybe the two most impactful ones for signaling reversals are the gravestone doji and the dragonfly doji. The gravestone doji appears at the top of an uptrend. It has that long upper wick and almost no lower wick. Think of it like a literal tombstone for the uptrend. It signifies a powerful rejection of higher prices and suggests a strong bearish reversal. Conversely, the dragonfly doji appears at the bottom of a downtrend. Long lower wick, almost no upper wick, like a dragonfly just touching down. It signifies a powerful rejection of further decline and suggests a strong bullish reversal.
Okay, now let's look at a pattern with a truly ominous name, the hanging man. This is a single candle pattern that signals strong selling pressure coming in after a clear buying climax has occurred. It appears exclusively at the top of an uptrend, distinctly indicating the end of that buying dominance and, likely, the start of a bearish trend.
Its structure is quite specific. It has a very small body, a short upper shadow, sometimes it's completely absent, and a very long lower shadow. That lower shadow should be at least twice the size of the body. Now, it can be green or red, but honestly, a red hanging man offers an even stronger, more convincing signal that a decline might be coming.
So its key characteristics are, it only appears at the peak of an uptrend. That short upper shadow reflects failed attempts by buyers to keep pushing prices up. If the close price is below the open, making it a bearish red candle, that significantly increases the probability of a decline. And that long lower wick, that's its most defining feature, right? It shows sellers made continuous attempts to push prices down during the period before buyers managed a slight rebound to close above the wick's absolute low.
Right. So when you clearly identify this pattern in the right context, it typically gives a strong sell signal. It suggests the beginning of a price decline. But again, confirmation is key. It's always smart to use additional indicators like the RSI, looking for those overbought conditions, maybe turning down. And also check a longer time frame chart to see if the bigger picture trend also supports a potential bearish outlook. Don't trade it in a vacuum.
Right, makes sense. So the market often tells more complex stories through sequences of candles, not just single ones. Let's get into some patterns formed by 2 or even 3 candlesticks. These often offer even stronger, maybe more reliable signals because there's more information packed in.
Definitely. Let's start with the dark cloud cover. This is a potent two-candle bearish reversal pattern. And like the hanging man or shooting star, it distinctively appears at the peak of an uptrend. It's a very strong warning sign that the bulls, the buyers, are losing their grip.
Okay, and its structure is pretty specific, right? The first candle is a large, strong green bullish candle, clearly showing buyers were in control. But then the second candle is a red bearish one that actually opens above the close of that first green candle, often creating a price gap upwards. But then its close price penetrates more than 50% down into the body of that first green candle. That deep penetration is the key. It shows sellers suddenly, powerfully overpowering the buyers.
Exactly. This pattern clearly signals the probable start of a decline. And what's interesting is its inverse relationship to the piercing line pattern, which is basically the bullish version.
Speaking of which, the piercing line pattern, that's a two-candle bullish reversal pattern. And this one appears at the end of a downtrend. It's the optimistic counterpart to dark cloud cover, sort of a beacon of hope for buyers.
Yeah, its structure involves a first candle that's a large red bearish one, showing strong selling pressure was dominant. The second candle, though, is a green bullish one that opens below the previous red candle's low again, often creating a price gap downwards. But then its close price manages to push back up and penetrate more than 50% into the body of that first red candle. This shows buyers aggressively stepping back in and reversing a significant chunk of the previous decline.
So the importance of the piercing line is that it indicates a strong potential reversal back to an upward trend. It shows a clear failure of that selling pressure. And generally, the larger the green candle's body is, and the deeper it penetrates into the red candle, the stronger the bullish reversal signal it's sending.
Okay, next up we have the harami pattern. The name harami actually means pregnant woman in Japanese, and it perfectly describes the pattern because it looks like a larger candle carrying a smaller one inside it. It's a widely used two-candle reversal pattern, and it signals a potential crucial shift in the trend.
Right, and there are two main types. The bullish harami appears at the bottom of a downtrend. Here you see a large red bearish candle, followed by a small green bullish candle that is completely contained within the body of that first red candle. Then there's the bearish harami, which appears at the top of an uptrend. In this case, a large green bullish candle is followed by a small red bearish candle, again, completely contained within the body of the first one.
The advantages of the harami are pretty clear. It's surprisingly easy to spot on charts once you know what to look for. It can sometimes lead to quite strong and significant reversals. And yeah, it's pretty popular among technical analysts for exactly these reasons. It basically signals indecision or a pause right after a strong move, which often happens just before a reversal.
Okay, another really powerful two-candle reversal pattern is the engulfing pattern. As the name vividly suggests, the second candle in this pattern dramatically engulfs the first candle. It indicates a really strong and decisive shift in the trend direction. It's like a visual representation of one side completely overpowering the other.
Absolutely. The engulfing candle is always noticeably larger than the previous one. Its body completely covers or engulfs the preceding candle's body, and sometimes even its wicks too. It's a very clear visual signal of market dominance shifting.
And just like the harami, there are two types here as well. The bullish engulfing appears at the bottom of a downtrend. Here, a large green bullish candle completely swallows up a smaller red bearish candle. This signals very strong buying pressure, just overriding the sellers and absorbing all their previous efforts. Then there's the bearish engulfing, appearing at the top of an uptrend. In this case, a large red bearish candle completely engulfs a smaller green bullish candle, signaling equally strong selling pressure is now overpowering the buyers.
Right. And to give you a practical trading strategy example, let's say you see a bearish engulfing pattern form near a resistance level. Once you see it, a common approach is to place a stop loss strategically just above the recent uptrend's peak. That protects your capital if you're wrong. Your profit target could then maybe be set down at a previous significant support level where price might find buyers again. And your entry, typically confirmed when the price closes below the low of that engulfing candle, showing sellers have definitively taken control for now.
Wow, okay. As you can clearly see, the nuance and complexity of these patterns, well, it can get quite deep, can't it? Recognizing them and, more importantly, acting on them effectively, it definitely takes practice and a solid understanding of market dynamics beyond just memorizing shapes. Look, getting good at this, really mastering these patterns and understanding market context, it takes work, right? And a deep understanding of how markets really tick. So for those of you who are really serious about learning trading and investing properly, maybe from the ground up professionally, there's a fantastic course available that teaches just that. We've checked it out. You'll find the link for that course in the description right below this video. Okay, so now let's move into the realm of three candle patterns. This is where the market can tell even more complex stories. These patterns are often rarer, but they tend to offer even a higher accuracy, maybe because you've got that extra candle providing confirmation.
Indeed. One such rare but often highly accurate pattern is the abandoned baby. And it occurs in two forms, bullish and bearish. The bearish abandoned baby appears right at the top of an uptrend. It consists of a large bullish candle first. That's followed by a doji, remember, that indecision candle, but with a clear price gap separating it from the first candle. Then this is followed by a large bearish candle, which also has a clear price gap separating it from the doji. Usually the first and third candles have pretty short shadows. This whole structure signals a very strong, often quite dramatic reversal downwards. It's like the previous trend has been literally abandoned. And conversely, the bullish abandoned baby appears at the end of a downtrend. It starts with a large bearish candle, again followed by a doji with clear price gaps on either side of it. And then it finishes with a large bullish candle, also with a clear gap from the doji. Like its bearish cousin, the first and third candles usually have short shadows. This signals a powerful reversal upwards, a really strong shift in market sentiment. Those gaps, they're key to its rarity and its accuracy. They visually isolate that moment of indecision before the reversal takes hold.
Okay, fascinating. Next, we have the three white soldiers. This is a three-candle bullish reversal pattern. It appears after a distinct downtrend, and it clearly signals a powerful upward reversal is likely underway. It's essentially the mirror image, the inverse of the three black crows pattern, which we'll touch on next.
Right. The conditions for the three white soldiers are quite specific. It has to form at the end of a downtrend. You'll see a red candle, maybe a doji, at the trend's bottom, and then it's followed by three consecutive strong green bullish candles. Each of these green candles opens within the previous candle's body and closes progressively higher than the last one. Often, the second candle is the largest, and the third is roughly the same size or slightly smaller. And importantly, the upper shadows on the second and third candles tend to become shorter or even disappear entirely. This indicates really strong, sustained buying pressure with very little resistance slowing it down.
Yeah, that sounds like a powerful signal. This pattern is often confirmed with help from other technical indicators like the RSI, maybe looking for a move out of oversold territory, and also by checking nearby support levels that might have held. You want to see everything kind of aligning for that potential upward push, right?
Exactly. Now, its ominous counterpart is the three black crows. This is a three-candle bearish reversal pattern. Its Japanese name literally signifies bad luck, apparently.
Yeah, right.
And it really does indicate the definitive end of an uptrend and the likely start of a decline.
Okay. And the conditions for the three black crows are that it appears at the end of an uptrend. It consists of three consecutive, usually quite large, red bearish candles. Each red candle tends to open within the body of the previous candle, or maybe slightly higher, but then closes significantly lower, creating this kind of downward staircase effect. Their bodies are typically medium to large with normal or maybe short lower shadows, indicating persistent and aggressive selling pressure throughout each period.
Right. Then there's the evening star. This is another powerful three-candle bearish reversal pattern. Like the others, it appears at the peak of an uptrend, signaling a probable downward reversal. It's the direct inverse of the morning star pattern, like night falling after the day.
Okay, its structure starts with a large green bullish candle showing the market was still trying to push higher. But the second candle is small. It's often a red bearish candle or sometimes even a doji. This shows indecision or a slight loss of momentum right at the top. Then the third candle is a larger red bearish candle that closes deeply, often more than halfway into the body of that first green candle. And crucially, there are often price gaps between these three candles, particularly between the first and second and third. These gaps can amplify the pattern's significance.
Exactly. And finally, we have its opposite, the morning star. This is a three-candle bullish reversal pattern, and it appears at the end of a downtrend, signaling a potential strong upward reversal, like the first light of dawn after a long, dark night for prices.
Makes sense. So its structure starts with a large red bearish candle showing the continuation of the downtrend. The second candle is small-bodied, which, like the evening star's middle candle, can sometimes be a doji. This represents that indecision, that potential turning point right at the bottom. Then, the third candle is a large green bullish one that closes strongly, again, often more than halfway into the body of the first red candle. And just like the evening star, price gaps often exist between the candles, reinforcing the reversal signal and highlighting that shift in power from sellers to buyers.
Right. And just to offer a quick trading strategy idea for the morning star, Entry is typically considered after the close of that third strong green candle. That confirms the bullish momentum has taken hold. A recommended stop loss, often placed strategically just below the low of the middle candle, the star part of the pattern. This helps protect against unexpected reversals and manage your risk effectively.
Wow, what a journey we've been on. From, the basic components of a single candle all the way to these complex multi-candle patterns. It's truly incredible how much information is embedded in these seemingly simple visual signals. It really is like deciphering the market's inner dialogue.
Indeed. And understanding these patterns isn't just about rote memorization, is it? It's really about learning to interpret market psychology.
Yeah.
That constant push and pull between buyers and sellers, those moments of indecision, the shifts in dominance, all with the goal of anticipating where the price might reasonably go next.
Yeah.
It really does transform what can look like a chaotic chart into a much more readable, potentially actionable narrative.
Absolutely. So as you reflect on this deep dive we've taken today, maybe consider these questions for yourself. How might learning about these patterns challenge your current understanding of market behavior? Maybe how you thought things worked. What implications do these hidden signals, these stories in the candles, have for your own financial decisions? Perhaps sparking new strategies or confirming ones you already use. And maybe most practically, how will you leverage this newfound knowledge, even if it's just the basics, to navigate the complexities of the market with a bit more confidence and clarity going forward?
Yeah, those are great questions. And remember, while these patterns definitely offer powerful insights, they're ultimately tools, right? They're not crystal balls. The true mastery, I think, lies not just in recognizing them, but in understanding why they form in the first place. And crucially, how they interact with the broader market context, the economic news that's out, the overall trend direction, maybe other indicators you use. It's about building that holistic view.
Well said. If you enjoyed this deep dive today and found these insights valuable, please don't forget to subscribe to the Deep Dive channel. We do more explorations like this into complex topics, trying to make them simple.
And we highly recommend checking out those important links we've put in the description below. They are carefully curated resources designed to help you explore this topic further and really reinforce what you've learned today.
Absolutely. And hey, if there's a specific topic or maybe you've got a stack of sources you'd like us to tackle in a future deep dive, let us know. Drop your suggestions down in the comments below. We do read them.
Yeah, we'd love to hear from you. And for those of you looking to go even deeper, remember we've covered related topics in previous deep dives, things like the basics of technical analysis itself or understanding overall market structure. Yeah. And we've got some exciting new topics lined up too, like diving into advanced risk management strategies, maybe even looking at the psychology of trading. So definitely stay tuned for those.
Thanks so much for joining us on the deep dive. Until next time, keep learning, keep exploring.